We're live. Go ahead, take it away. Introduce yourself.
Okay. Hi, I'm Lonnie, and I'm joining Lane today. I'm just here, curious about the whole real estate investing thing. So, yeah.
All right. So
How
we
you
are
doing, Lane?
close. Good. I'm doing good. So folks have submitted some questions. You're gonna help read them at the very least. But you always have good questions. So we thought
Okay.
we'd bring you on and kind of host the show along with me. And then if you guys want to put in your questions and comments into the comment below wherever you guys are watching, we'll see it. We will actually see it, and then Lonnie will pull it from the comment box and might even get your question on there. We may even post it live for everybody to see too.
Mhm. All right. So the first question we have is, what are the risks of investing in a real estate syndication?
So when you're investing in a real estate syndication, you're investing through a process of an LP partnership position, so limited partner. So in terms of like, we're talking about buying a rental property earlier. And when you own a rental property, you really got to kind of worry about liability of tenants slipping and following, possibly suing you as the landlord. So with when you're in an LP, you're a limited partner. You're not the person making decisions or the managing general partner. So this is what the beauty of a limited partnership in a syndication is, that you really have not too much liability on your hands. And then, we were kind of talking about buying a rental property. You're going to have to take out the debt on your own. You're going to have to show at least like a 600, 680 score to get the best rates. No, no delinquency or bankruptcy on your record. But when you're investing through a syndication, like the debt doesn't get put in your personal name, so it's not going to show up any reports. But gets put in the key principals or certain general partners. The debt gets put in their name. So
Mm,
in term, that's liability, and that's like the debt risk right there. Um,
mm.
Other than
We do
that,
have
you
a
got to
comment.
really.
Oh,
Oh, you got a comment already.
yeah, we have one from Daniel Markert, and he says the risks are not having enough capital to take advantage of all the deals.
Oh,
Hmm.
he's being funny. He's being funny. Yeah, there's a lot of good deals out there, and most people are going to get to a point where they just run out of money, and you just got to kind of wait till the money comes back. But kind of wrapping up the question here, the big risk, in my opinion, is just working with bad people.
Mm.
I've gone into a deal, kind of lost all my money. People can read that
Ooh.
story at simplepassivecashflow.com/fail. But
Oh,
I just invested with somebody, and turned out they were a shyster, ran off with the money. I think they hid behind their LLC, and they made the LLC go bankrupt. So there's really nothing to go and claim. But that was back in like 2013 when I went and did that, and lesson learned. And you build a
mm.
network, you figure out who to work with after that.
So what about the people who are like faint of heart, they don't have courage or like they have trust issues? Do you think like real estate syndications for them?
I think it's good that like you buy some of your own rentals first, and then you start to realize, well, it's kind of like two hard things here, right? Like you're gonna get beat up with tenants, you're gonna have all these repairs, and then you have to like worry about property managers just kind of not only stealing your money too. I mean, because that happens, but like property
Hmm.
managers kind of being not really good stewards with your money, and just getting repairs done by their friends, or just kickbacks and different things like that, or just going with the cheapest, most expensive and convenient option, it may not be the best case scenario for you as the investor.
Mm.
So I don't know. I mean, every time somebody asks that one to me, is I always say like, well, if you're fine with your situation where you're at by just working at your job, saving 10, 20 grand a year, putting it in the stock market. I mean, we all know that's going to happen, right? You can do math and figure out what's going to happen there. But if you
Mm.
want to do something else like this, then hey, here's the option.
Hmm.
The
Well, there we do
analogy
have
I
a
use.
question. Oh,
Oh
yeah.
yeah, go ahead,
Oh, no,
boss.
no, no. What's the analogy? What's the analogy?
The analogy, and you'll like this. It's kind of like one of those like babies, green sea turtles, right? When they're born, they run all the way to the ocean at
Oh
nighttime
yeah.
under
Uh-huh.
the cover of the moonlight.
Mm.
And if you all watch that video when you're kids in elementary school, when the teachers were just so too tired in the afternoon, they just want to make you watch videos. Like there's all like the birds and the cars run over the turtles, and there's all these things that like just get the turtles before they make their way to the safety of the ocean. And once they get there, they're all right. But as a syndication, especially LP investor, you're kind of like
Mhm.
that turtle because in the beginning you don't know anything. You don't have a network. I mean, when I started doing this stuff, my parents never owned rental real estate. I didn't know anybody who had a net worth of $1 million or more. But once you kind of jump into the ocean and swim around with them, other people and play nice and build relationships, you're going to be all right.
Okay, we do have a question that popped up from Jacob Taub. He said, "Would you recommend selling my smaller properties and put them in a bigger deal?" It's situational, isn't it? Depending on what other
Yeah, I mean, maybe
like
if Jacob
area.
a bigger, maybe Jacob can like clarify there if he's meaning like a syndication deal or like a fourplex, eightplex. Um, Very situational, of course, and it definitely depends. Like the first question I'm going to ask is like, what is your net worth? If your net worth is
Mm,
still under $250,000, like, I mean, be like me and just keep buying rental properties until you get your net worth up to a certain level um, to partake in the bigger deals. Did say bigger, not booger.
well, in the meantime, I guess we can go to the next slide while he's clarifying. And that's what questions can you ask a sponsor to understand how they are addressing the risks of the deal?
So a lot of this is covered in the syndication e-course. But what questions do you ask? Well, a lot of it has to do in the pitch deck or the information that's given to you. I mean, you as an investor should pretty much know if you're going to invest in a deal without really having to ask extra questions, in my opinion. If you have to ask extra questions, then you probably shouldn't be investing in the first place, or you haven't looked at many deals already. So that's where education is kind of the first step, I think. And if you guys want a list of, I don't know, like there's like 50 or 100 questions, we have that in the syndication LPE course. We have a little scorecard that you can kind of put in some quantitative and qualitative aspects of the deal. But then there's also in the appendix just a laundry list of questions. But don't talk to people or don't talk to sponsors about the questions because it's not meant to ask the questions. They're just kind of questions for yourself to kind of sit and ponder. But most people, after you've been investing in a few deals, you kind of have like a pretty good understanding of generalities of what the deals are and how they work. And at that point, most sophisticated investors don't. There's really not many questions to ask.
Hmm, okay. Well, another question we have is there any advantage to mixing syndication with rentals?
Oh yeah, hey Junior. Um, Advantage of mixing syndication with rentals. So this is where I kind of recommend for those folks that are still under $1 million net worth as they're transitioning over from direct ownership and rentals into the passive route in larger deals as a passive. Cool, right? Like you've probably built up a pipeline and have some pretty good deal flow, and more importantly, have already built up teams with the single family home rentals or the small stuff on your own. And now you just open up a whole new basket of additional opportunities coming your way with the syndication deals. So with these two baskets of traps to get deals, yeah, keep them both open, and the more deal flow you have, the better, and just cherry pick out of the two, right? Like we're all, as Dan kind of mentioned earlier, we're all kind of limited by the number of funds we have. The more deal flow that you have, so you can be more selective, is always better. But people, if you're already an accredited investor, net worth $1 million or more, you make a high income, and you haven't done the single family home or done it on your own, you're gonna have to create all the teams on your own. You're gonna have to kiss a few frogs. To me, that's a waste of time, right? I mean, I would just kind of go straight to the big stuff. It's kind of like the analogy I use there is, like for a lot of good NBA players, they just skip college, right? That's a waste of time. They're just gonna like sprain an ankle or tear an ACL, and they're just not gonna capitalize on their talent. Um, it, like by a lot of the stuff that you learn in by doing single family homes are important, but it's nothing that you can learn academically or overcome with a strong network of other pure passive investors. Um, I guess where you're at, Lonnie, like I probably want you to go get a rental property to kind of learn this stuff. You don't have too much money, but
Mm-hmm.
and I think that'll pay dividends in the future, right? Because if
Right,
you
yeah.
could plop you down at a table with five other accredited investors, you know, you'll be able to hold a conversation. And most accredited investors, especially if they went straight into the passive investing route, they probably honestly don't know too much about investing, right? They kind of know it from a more of a black box standpoint. But by you going out and buying some rental properties on your own, going through the trials and tribulations and the headaches, you'll kind of understand what goes on in that black box, and that will pay dividends by analyzing deals and building relationships with other people, but it's not entirely necessary.
Mm-hmm.
Oh, so we got a comment here. So Daniel says direct ownership or rentals can be used as active income in your own business. The syndications are passive, depends where your day job and network are. Um, so my response to this is like, you don't want active income. You want to get the heck away from active income. You want more passive income. So if you want direct ownership of rentals, like I don't know why you would want to do that in the first place. I mean, if you want ordinary income, go get a job, right? We don't want any more of this. This is why I don't know why house flippers flip houses or do this burst strategy stuff, because it's all ordinary income, active income. You want to get away from that type of stuff. Um, but yeah, it does depend where your net worth is at.
Hmm. No, I don't. Okay, we mentioned I don't have a lot of money, just being young and stuff. So while I'm saving up to buy real estate for rentals in the future, maybe like in a few years, could I put my savings in like say like stocks and stuff? I know you don't like them, but hypothetically, if I put them in stocks, I at least grow the savings amount if things go
Yeah,
well. That could
yeah. I mean,
work, right?
yeah, I mean, it is what it is, right? I mean, I think that's what's
Yeah.
hard when you don't have that much money. You have a bunch of garbage options available to you, right?
Mm-hmm.
Because you could
Yeah.
do that. You could put it in stocks. You might make some money. I mean, you're probably gonna
Yeah.
make money, right? But
Mm-hmm.
you could also lose half of it overnight, because that stuff is like a roller
Mm-hmm.
coaster. Or you put it in like some kind of savings bond or low yield savings account, or maybe you do
Mm-hmm.
BlockFi at 8-10%. I mean, that's another option. There are some other risks
Mm-hmm.
there associated with that, but I don't know. It's either what's your thoughts? Like, are you gonna want to put it and make at least 1 to 2%, or you gonna put it in your mattress, or would you rather gamble and make 8% on the time that it takes you to save the money?
Mm-hmm.
What's your inclination and why?
I just don't want to let the money sit. If it has a chance to make more by not doing anything, then I'd rather do that than just like, yeah, have it under a mattress and just have the same amount and not
Yeah,
have it grow.
I would agree. And the way I would look at it is like, yeah, I mean, you don't have that much money, so you got to take on some risks, right? So, yeah, the stock market goes up and down, but if you put your money in the other stuff, then it's just gonna stay where it's at, and you're playing the game not to win. And there was another comment here that I don't particularly like. Waiting for blood in the streets. I mean, hey man, if you don't tell me what you have, right? If your net worth is under $1.5 million, you got to get out there. You got to take some chances. You got to get some money in the game. I mean, I mean, I mean, that's a big thing. Like, people are always like naysayers, and they're very negative, and they're always like, you can find these message boards all over, but that's why you invest for cash flow, right? As we were saying, which is very different from investing for appreciation. Going back, someone put in a comment here: direct ownership or rentals is not entirely active. You can hire a good property manager and make it relatively passive. Yes, it's not as passive as syndication, but a good property manager can bring you the time you spend down to 1 hour a week. Yes. Yes, I do agree with this. But the direct ownership rentals, we're not talking about if it's active or passive. Turnkey rentals are not really, you can make it really passive, right? But we're not talking about that. We're talking from tax standpoint, right? When you're doing direct ownership of rentals and you're like doing wholesaling, flipping, that type of stuff, that's gonna be ordinary income. That's kind of what we were talking about earlier. But yeah, when you own like passive long-term rentals, that is going to be passive income more than likely. Of course, I'm not a CPA person, but um, that was the educated conversation I would be having with my tax professional.
Hmm. We have another question. For accredited investors, what's the advantages of having single-family home rentals over syndication, if any?
Yeah, so like for accredited investors, especially the people in the family office group and high net worth people over $1 million, it's kind of a running joke. But people say, well, can you tell me any freaking good reason why you would own any rental properties? Earmuffs, Lonnie, right? Earmuffs. Don't pay attention to what we're saying now, right? Go out and get your rental property, get your net worth up, right? But I mean, when you, if you can find people that you trust, like you're in better deals, you're doing value add, and the big ones are you don't have liability like you have with rental properties. You got to mess with all these silly LLCs when you have rental properties. If you have substantial net worth, um, if to me, and this is just my non-legal opinion, if your net worth is under 250,000, 500,000, you don't really have much to worry about because nobody really wants to sue you because you're already broke. You're not a big target for a litigation lawsuit. Um, and at the worst case scenario, you go back to zero. I mean, yeah, that sucks, but it's not like you had $1 million or $2 million and you had to go start back at go. Um, and then the other one is, you don't have any debt in your own name, right? When you're a passive investor, you're just an LP. Kind of the worst that can happen is you just lose your original investment. But when you have direct ownership and rentals, you have all this pain in the butt stuff. Most accredited investors too, they're like, well, I need more than 10, 20, 30 rentals. And as Anik said, yeah, turnkey rentals can be very passive, but anybody who owns more than 5 rentals will tell you they're a complete pain in the butt. Uh, Earmuffs, of course, Lonnie, right? Go and get your first rental properties. It's kind of like, I don't know. It's like everybody's got to go through puberty, right? I mean,
Yeah.
it's kind of like one of those things. You
Mhm.
do learn some things, and I don't know. When you are a passive investor sitting around not doing anything, collecting your checks, it makes it life so much sweeter. It's kind of like when you get that first job, it sucks, and then when you finally get to like upper management 20 years later, it makes it so much sweeter. And then now you can abuse the new people at work.
Okay, why don't we move on to the next slide? And in the meantime,
All right.
answer more questions from the comments because there are two. So the first one's coming from YouTube. How do I allocate 350,000 over the next 3 years? This person is burnt out on evaluating syndications and feel like their exposure to them is high enough. Infinite banking? Cash?
So $350,000 is not very much money, bro. Like I've seen people invest $1 million in 9 months. Um, how would I allocate 350? I would get that deployed in the next year or two. If you once you found people wanted to work with, right? So okay, let me answer this two ways. If it were me, I already know where to put my money. If I had 350, I'd deploy that in like easily 3 to 6 months into 3 or 4 deals. Like anywhere from 50 to 100 grand each, but I already have the network and I already know the people I'm going to work with, and I already have proof of concept because I've invested with them in the past. But if you're brand new to this stuff, the prudent thing is to put money in and play and get proof of concept first. Like just when back in 2012 when I bought my first out of state rental. I mean, I didn't know it would work, but I bought one, it worked, and then I sold all my Seattle rentals and I bought 9 the year after. So with that strategy in mind, what I would do is take your $350,000 and test different operators and sponsors and asset classes, and usually the minimum are like $50,000 at the very least, and maybe you go into a few deals at 50, and then you sit and wait for 6 to 18 months. Even though that's still a pretty short time to figure out if the person that you're working with is legit. But that would be kind of my way of doing it. $350,000 is not that much money. But if you had a little bit more than that, yeah, if you had a little bit more than that, maybe I would do an infinite banking policy just to get the money rolling. So maybe I might, deploy 200 grand over the next 6 months and wait, and maybe do a little infinite banking policy of like 25, 50 grand for every 6 years. But if people want more information about the infinite banking, reach out. I can connect you with the right people.
And for those who don't know, what's LLC?
LLC is a limited liability company, like an entity. So it's kind of like it's instead of you owning a rental property and taking all the liability, there's kind of like a barrier there or a corporate veil, so that if say somebody tripped and fell or died, right, and like a lot of times people don't realize like there's several layers to get to you to sue you, right? There's insurance. You always should have insurance. I think you should have umbrella insurance too on top of that. And then you should always be acting without negligence, right? Like, yeah, you hear a lot about frivolous lawsuits, but for the most part, a lot of the people that you rent to, they just don't have the funds to mount a frivolous lawsuit like a lot of people in California do. That's why we don't invest in California too. But then let's just say, those 3 barriers failed on you. Then a limited liability company is something that you would hide behind. So like if I sued you for $1 million, you don't have $1 million, but if I did, you'd be able to hide behind that LLC. I mean, it's not a foolproof thing, but then you have to weigh the costs, right? It costs usually about $500 to $1,000 to set up, and then you have to upkeep it. There's some fees every year to pay. It's kind of a pain. You have another checking account and do some other things to uphold and make like you're reacting in accordance of your business entity. But I mean, in certain situations, it might make sense to just kind of roll without it. And that's where I put my disclaimer to cover my butt, saying I'm not a lawyer. But of course, every lawyer is going to want you to make all these entities with them, right?
Yep. And you did mention California, so we're going to skip to this question, which is asking Lane, what are the cities in the U.S. you foresee the highest growth? They're not in California, are they?
I mean, California is growing because I think people are starting to come back to the cities, like New York and Los Angeles and the Bay Area. But the reason why I don't go there is because they don't cash flow, right? Like my big criteria is like I want a place that's growing, and I want to be able to cash flow day one, because in case Mr. Brian here is correct and we're all going to see blood in the streets. Right? Like the California markets are cyclical; they go up and down like a wave, right? Just like how you're saying earlier about your stocks, right?
Right.
It's up and down, yet you're willing to make the risks. It's a calculated risk, and at least you had the right thought of risk and reward there. But if you're a gambler, sure, go to California, I guess. But if you want cash flow and you want a bit of growth, I like Phoenix, I like Houston, I like Dallas, Huntsville, Alabama, Atlanta, Georgia. Um, I'm not too familiar about the Carolinas or the state of Florida, but I see a bunch of cities in there popping up quite often.
Okay. So then what do you think about jumping into multifamily slash apartment investing sooner than later? I find buying one single family home at a time painful. It's coming from Ankit.
Oh, I'm wondering
Just
where you're
above.
getting these questions are.
Yeah, that's
Okay,
the that's the question I
you
skipped
can
over.
click on it and it'll pop up.
Really?
Yeah, yeah.
Oh, well, that's not working on my end. That's okay.
Yeah. So, this question, I mean, define multifamily, right? I define multifamily as 60 units, 100 units, and larger, right? I mean, if it's smaller than that, I still consider that residential type of assets. So
Hmm.
I'll make that differentiation between residential assets and commercial assets. But what I would say, it depends on your net worth, right? If your net worth is, I mean, and also that we're also talking about, are you an operator of these 8 units, 4 units, 50 units, 100 unit building? Like maybe if Anik can clarify his question where he is at, or at least kind of say, I have a friend in his situation, he's got $1 million net worth, he makes 200 grand a year. Where is he at and what has he done already? Um, every situation is different, but I think one big mistake I see from a lot of people, and they're not really in our simple passive cash flow group. These are the broke guys that don't make any money and they don't really have good jobs. So they get kind of tricked into these programs that say, give us 20, $30,000. We'll teach you how to go buy apartment complexes because anybody can do that. Just skip over and do the big stuff because there's so much economies of scale. And I kind of just laugh because, like, dude, it's not gonna happen. Like we should make a program and charge people $20,000 to trick them into thinking they can run through brick walls and go buy large apartments. Like, dude, it's not gonna happen, man. Like, and especially if you live in California, like if you want to get serious, like you got to go and visit the properties and go shake hands with the brokers. And like we're selling some properties now, and then the conversation with the brokers, well, who actually visited the properties? Like we're getting dozens of offers, and like we automatically we all these like stupid like offers from like computer programmer from like Silicon Valley, wherever. We just throw them out because these guys don't even visit the property. We know that they're not super serious. And then we look at if they've closed 60, 100, 200 unit properties in the past and they don't have that on their track record. We as sellers just automatically just throw it out. The brokers throw it out for us because they don't want to mess with those type of buyers. um, and if somebody has no experience and is winning a deal like that, you probably want to run away because the broker's just selling you a sucker deal. um, but I don't know. That makes sense. Hopefully that makes sense. I mean, to me, I think it's all part of the journey, right? Buy rental properties, get experience, or if you're already a passive investor or accredited investor, get into passive real estate investing, um, as a passive, and go up that way.
Hmm. Well, then let's go back to the presentation a bit since
Okay, back
took
to
a
the
break.
presentation. We have a lot of questions here.
Yeah, yeah. Oh wait, what are K1s?
Okay, so K
Is
ones
there a
are
short
like,
answer?
it is a short answer. It's like it's basically a tax form. It's like 2 or 3 pages. It's real simple, and it
Oh, okay.
tells your accountant like, all right, you went into this deal and how much passive losses you
Hmm. Hmm.
have, how much
Okay.
gains you got, and it's so much simpler than like when you buy a rental, you're gonna get like either a Schedule E or Schedule C, and people can Google that what that looks like, but it's super
Okay.
confusing. And you gotta have like
Hmm.
your all this like expenses you gotta break down, and
Oh.
that's just how the world works, right? Like in when you're starting
Hmm.
out, it's always so much more complicated and harder. But like when you
Hmm.
ascend the mountain, things get so much simpler and easier.
Mm. Mm. We also have a comment on the rents being flat in Hawaii since 2015. You probably have like a website, simplepassivecashflow.com slash dot 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 with all these cities, right? That you're
Yeah, I mean,
mentioning.
great resources for rents are like ALN,
Mm,
multi-housing news. I mean, a lot of
hmm
like that's why I like investing in apartments in the commercial world because the data is so much readily available. Whereas like residential property rents are so all over the place. I mean, houses are so like unique. They're like special snowflakes where like apartments are just a box. It's a commodity.
mm, mm. Well, okay. So here we have the question on the PowerPoint. I am
Okay.
concerned with interest rates going up. Should I be concerned if the value of my property also goes up?
Okay, so people always ask like, what happens if the interest rates go up? Well, let's think about it. Well, interest rates go up when the Fed doesn't do anything to cool off the economy by pushing um, when interest rates go up, the economy is doing well, right? That's kind of the way it's played, and people you could probably argue against me, but this is the way I see the economy working. When things are bad in the economy, what the government does is they stimulate the economy by lowering interest rates down, right? This is kind of seen as like dry powder, right? They'll raise interest rates. I mean, this is maybe happening, I think, like 2 or 3 years ago. The economy was doing really well. So, what the government did, what the Fed did, is they increased interest rates quarter point at a time. And interest rates were sort of increasing because the economy was doing good. And by the way, what happens in a good economy is your rents go up and your prices of your properties go up too. So if you already own real estate, it's awesome, right? And I think people get caught up with interest rates going up. It might is typically bad and seen as that, but if your prices, your properties, your rents are going up, you're going to win way bigger on that side anyway. Um, so it's kind of like one of those things where the winners are going to be people who are holding on to assets that are going up with this stuff, and it's the people that sitting around saying, it's too overheated. The bubble's got to pop. That's those are the people going to be the losers, in my opinion.
Mm,
But does that make sense, right? Like when interest rates are they move interest rates down, right? So it's a reactive thing. When you have the economy doing well, the government wants to get some what they call dry powder, right? In case the economy does bad. So what they do is they increase the interest rates so that they can decrease it and apply that stimulus into the economy when things get bad, right?
mm,
So look back in 2008, right? What the Fed did. 2008, the Fed lowered the interest rate, and what that does is it kind of increases liquidity into the markets and will make the stock market go up, and it makes the economy go up because now companies can borrow money at cheaper prices to put back into their business to hire employees. That's the way
hmm.
the economy works.
Okay. Okay. I guess let's just head to the next slide.
Next slide. You're the boss.
Yeah. So how can I join the club? I'm starting with wholesaling, looking to communicate with investors and be a productive member.
If you're into wholesaling, you probably don't have too much money, and our club is probably not for you. I mean, like most of us, like we have good paying jobs. We're either accredited investors already, and simple passive cash flow was made for the working professional that kind of followed the old dogma of going to school, studying hard, getting a good job. I mean, if you don't make more than 50, 60 grand a year, we're probably not the group for you.
Hmm.
Sorry. Everyone wants to be inclusive these days, but you need money to invest. I was talking to
Mm,
somebody yesterday. They're like, they don't have any money, and they want to buy like rental properties. And I was like, this is real estate investing, bro. If you don't have money, you need to work on your personal finances. And they said, well, I'm already like living really frugally. And I was like, well, you got to make more money. What do you do for work? Well, I don't work now. Well, that's your freaking problem, right?
True.
I
Yeah.
mean, I'm not here to go tell you go read a personal development book, right? Maybe that comes later,
Mhm.
but like you got to make some money. You got to make some income.
Mm. Mhm. So then
And
we
I think
have.
that's where college comes in, right? Like
Oh
I think people
yeah,
think
yeah.
college, but college
Uh-huh.
helps you get that job, right? Which you
Yeah,
put
yeah.
into side to make money.
Uh-huh. And then we have Brian mentioning a name. Who's Grant Cardone? Cardone?
Oh,
Grant?
you don't know who this guy is? Every
No.
millennial under the age of 30 knows this guy because they think he's like the coolest guy.
Oh
Yeah.
my.
Do
Okay.
you know who
Well,
Dan Bilzerian is? Have you heard of that
I've
name?
heard the name. I've heard of that name. I haven't heard of
Yeah,
this guy.
he's that guy's a tool, right? That Dan Bilzerian, he turned out to be all fake, right? Grant Cardone is kind of like the Dan Bilzerian of like business and
Ah.
entrepreneurship.
Oh.
Yeah.
Okay. Any thoughts on him in particular? Any?
So he goes along on he like gives a lot of financial advice, and I think a lot of it is
Mm.
good like mindset wise. But
Okay.
he also invests in real estate, and yeah, thanks Daniel. That is the other guy. This guy's a hoot, Dan
Uh-huh.
Bilzerian. He's a hoot. Go look at the YouTube videos on this guy. But you know,
Okay.
like this is why like you got to look. I don't really follow like these internet gurus because they're all just
Mm.
fictitious people, right? Like, I mean, I guess I kind of do that a little bit, but like I try and find people who are actually doing things and real investors. And this is another reason why I don't really follow economists. To me, they're just kind of
Mm.
like weathermen. You know, they predict what's
Yeah.
going to happen in the economy, but they have no skin in the game.
Yeah. Oh, Daniel also put another comment on multifamily homes. If you want to put that up, since I can't really highlight. Yeah. What do you think about that?
So he says multifamily real estate syndications typically require at least $50,000 minimum investments. Frequently, it is 100K, and most require you to be an accredited investor. Um, so I think he's right, but you know,
Mm.
in the private placement world, I mean, anything kind of goes. But typically, when you get a more institutional operator, um, you know, institutional operators like someone who's been around a long time and they have a big staff, a lot of fees, kind of like shopping at like Saks Fifth. You know, those
Mm.
kind of really expensive companies.
Mhm.
Um, your minimums are gonna be like $100,000 to $250,000. Higher fees, lower splits. But if you find some newbie, I'm sure they're desperate to take whatever money you got. You know, 1,000, 25,000. But I wouldn't want to invest with them. I don't. I don't really want to be one of the first person in their first dozen deals. I don't know. It's kind of like going to like the massage school or the hairstyle school. You ever done that?
Mm. Mm-mm.
Don't do it. I did it once. Yeah.
Really?
And that was when I had a
Oh,
buzz
what a
cut.
story.
That was
Oh.
when I had a buzz cut. So I was more like risk tolerant back then. But it
Mm.
jacked
Mhm.
that up. So I'd never want to do that again. And the problem, it took too long. Yeah.
Oh, yeah, yeah. It took like hours. Okay, well, what is daisy chain lending then?
Okay. Let me get rid of this comment.
Oh, okay.
Okay. Okay. What is daisy chain lending? So if you go and look up and like on LinkedIn and you type in the word like lender or lending broker,
Mhm.
everybody is a lending broker out there. So I don't really know. I've never been a lending broker before. I didn't go get my broker's license to do that. But a lot of these guys they'll go and get this license, so now they can get access to kind of the bankers like portal, and now they can go and sell people on like getting money. You know, so they'll make some
Mm.
kind of company, they'll get an LLC, and they'll put all this like little like institution looking business together, but it's really the guy and itself. And he's still working his day job too on the side. This is just how he gets some money on the side. But a lot of these guys will just be pure like network marketing, or they'll go around and then they will apply huge markups to the loans that they get on their computer, right? They're just wholesale, not really wholesaling out, but like reselling the same loans that anybody bank could do, because they have a relationship with you and they come across as like, oh, I'm capital lender guy, right? You need money, I'm your guy, right? But these guys are very a dime a dozen. It's a very ubiquitous type of thing, and the term that we use is daisy chain lending. Anybody can kind of do it, kind of like daisy chain deals, where there's a deal, he passes it to four guys, that guy passes it to eight guys, and that guy passes it to 64 guys. The deal
Mm.
sucks because that's why it has to go to so many freaking people that are unsophisticated. But that's something to be on the lookout for. If you've ever seen a guy on LinkedIn, I always just tell my assistants to just block these people because they're kind of a waste of time, and they're usually really aggressive in terms of networking. I mean, you go to any real estate club, you're always going to have a handful of these types of guys. They don't really add any value. Um, just go to the legitimate guys who actually run a sustainable business, because those are the guys actually adding value to your transaction. They're the one advising, and they've done a lot of quantities, and they have lower fees, and they add more value at the end of the day than a lot of these one um, one person wrecking crews, I guess.
Mm.
You
Okay.
can be a you
That's,
can be a lender if you want to, Lonnie. Like, just go get the license, and then
I guess
like,
I could.
if you're good at talking to people and gaining their trust, you can give them like
Mm-hmm.
a loan, and charge them hidden points and make a lot of money that way.
Sounds kind of
Now you
sneaky.
know. It is
Yeah.
super sneaky. Yeah.
Oh, okay.
Daisy chain
Well,
investing. Be on the lookout for it.
okay. I'll keep it in mind. Okay, let's hit the next one.
Okay.
Okay. Somebody's heard you talk about Bitcoin slash crypto scams before. Can you elaborate?
Okay, this one is very similar to the last one. Um,
A bit,
so,
yeah.
so in the crypto world, right? Like, we all hear about um, Bitcoin and Ethereum, are kind of like the blue chip type of investing in cryptocurrencies. But I don't even know how many. Like, I'm sure hundreds of these other altcoins out there, where they're just pretty much like tech startups. Unfortunately, anybody can invest in these things. So, and this is what is, I get concerned a lot, or I get a little upset that not everybody can participate in private placements and syndications,
Mm-hmm.
because not everybody should, right? People under, non-accredited investors, a lot of them just don't have the aptitude to be able to make good financial decisions. They don't know what questions to ask, they don't have the network. But unfortunately, in the crypto world, there's all these altcoins and these, have you heard of Dogecoin?
Yeah,
Yeah, that
I
stupid
have.
Shiba Inu dog, right?
Yeah.
So the Dogecoin is like a great example, right? It's just like this crap coin that everybody knows is just a complete joke, right? The owners already have a track record. There's not really built. There's no technology. It's not really a thing, but the price is going up right now, and it's kind of symbolized by like a little Shiba Inu doll that does a bunch of fun things and little different internet memes. And if
Yeah.
you guys are bored tonight with it being the weekend, go to the Reddit Dogecoin threads. It's hilarious. The hashtag is like Dogecoin to the moon. Is what people say. But
Oh,
anyway, yeah, I know, poor dog, right? It's a kind of a cute dog, and the
yeah.
saddest thing is like the owner of the dog, um, they kind of came forward, and they're it's like their dog, right? And everybody just keeps using this thing to put on this as a face of this internet meme for this like just garbage altcoin. But
Mhm.
anyway, like, so a lot of these like altcoins, they're just garbage, and they're going up, just like the dot com, right? Like, era,
Mhm.
when if you got a dot com on your name, it was just getting bid up. Same thing here.
Mhm.
Bitcoin and Ethereum to me are super solid, right? But like, I'm trying to differentiate that from altcoin and all these types of tech startups. So there's just a lot of
Mhm.
garbage there, and it's essentially a Ponzi scheme, right? The way it works is like people buy in, and there's a certain lockup period, right? They're all different. They're all on these like kind of like lesser known platforms out there, and it's basically like a Ponzi scheme. right? The people put their money in, but there's a lockup period. So the thought is the first people in the beginning get out first, and then they bring in other people, like a multi-level marketing thing, to bump the price up so
Mhm.
that the founders can get out, and then the whole thing crashes when the majority of the people in there. So you see a lot of these like scams on like Instagram. Like I can kind of pick them out pretty easily when I was kind of scrolling the other day, when I see just a bunch of unsophisticated folks just like pumping up this one like coin, and like they're making like t-shirts, and like they having these like clubhouse, right, clubhouse events and all these other internet events, pumping up like this coin, and they're trying to make all this like internet hysteria, and where it's just kind of like it's just all fake. And I don't know if you've seen out there that Netflix video, the Fry Festival. Have you heard about that? It was like
Nope.
a so that was like a dance concert that never happened. That like
Oh.
people like Ja Rule and all these like Instagram
Mhm.
celebrities started to pump up,
Uh-huh.
and it was just a fake
Oh.
event.
Yeah.
They got a lot of money, and the event never
Uh-huh.
happened. But it just
Uh-huh.
kind of proves the power of the internet and how people are just kind of lemmings out there. And yeah, people don't like follow like big brands like Coca-Cola, Pepsi,
Mm.
Quicksilver, like those types of things. But they go after like the micro influencers, like um,
Mm.
Kylie Jenner, Kardashians, or people
Oh
like Grant
yeah.
Cardone, right? Right.
Uh-huh.
I mean, what millennial watches like freaking like cable TV, right? It's all the like the small micro influencers on YouTube, Instagram,
Mhm.
TikTok
Mhm.
these days, and at some point that's probably going to be the majority of people. Um, but yeah, people will use these micro influencers, and they'll create these multi-level marketing schemes to pump up a coin just so that the beginning people can get out and it all collapses. So be on the lookout for that. I mean, altcoins are just high risk, high return
Mhm.
type of stuff. I just don't think that it's a good risk adjusted return.
Mm. Okay. Well, we do have a fun question from Mauricio saying, let's talk agriculture like coffee in emerging markets like Colombia. Diversify from the dollar a bit. Scarcity, lifestyle investment. Am I right? I don't
Uh,
know. Am I understanding this question?
yeah, I mean, I think like our world is all alternative investing, and you do see a lot of this
Mhm.
agriculture stuff come up. I
Mhm.
just haven't. I mean, can anybody show me one freaking person that has invested in this stuff has made money? Like can can somebody please present? Can I shake the hand of somebody who's actually made money with this stuff? I don't like it because it's out of the country. I mean, America
Mhm.
is like I like America because we have the best legal system. When you buy something, there's kind of clear title to it. Um,
Mm.
a lot of
Mhm.
these other countries, it's just none of the such. And America has the
Yeah.
best rent to value ratios. I
Mhm.
just don't think that why if something's working, why do something else?
Mm. Well, he says he's just teasing. So
Oh,
let's go to the next question.
you're
Drum
trolling me.
roll.
Okay. Well, I think we're kind of out of time here.
Oh,
We pay
oh,
you by the
okay.
hour, so we are getting to the top of the hour here. Unless somebody wants to put in a quick question to wrap things up here. Um, if you guys like this stuff, or if you guys, the free gift, we want to give people a free gift for staying to the
Mm.
end. Um, I'm giving away the Remote Investor Life course, and it's like
Mm.
8 hours of video. Uh, Shoot me an email at lane@simplepassivecashflow.com, and then put in the subject line LITE, and then my team will get you guys access to that. Um, and yeah,
Oh, how nice.
anything
8 hours of you talking.
I know. Yeah, but the reason why we give it to them in that as opposed to this form is
Mhm.
they can fast forward. So it's like 4 hours when
Oh,
they're
yeah,
doing
yeah.
chores, right? The chores that they should probably
Uh-huh.
be doing anyway.
Mhm.
But all right. Well, if that's it, we'll see you guys maybe
Okay.
a month or two from now with some more live questions. Bye.
Okay.
Thanks, Lonnie.
Bye.
Everybody
Yeah.
say Lonnie, good job. Bye.
Bye.